Good morning, folks. This is the Danielcode report for Monday the 8th of December, and we're going to review the price action in the gold market last week, and we're also going to have a slightly more detailed look at the Dow Jones. For those of you who trade the S&P, you should be able to follow along on your S&P charts. Both the Dow Jones and the S&P move pretty much in unison. So we'll start off with a look first of all at the COMEX gold chart. And this is the COMEX Gold daily chart. It's our first chart we're looking at. And I wanted to just highlight to you how trading went last week and what you should have been prepared for, bearing in mind that last week was Thanksgiving. So Thursday was a market holiday for Thanksgiving. Friday was a half day for equities. And on Wednesday, the bond market closed early. Now, what you need to know is that the bond market is the market, and when bonds are closed and they don't run to the same hours or indeed have the same holiday timetable as the equities, but when bonds are closed, effectively all the equities are doing is marking time. So if we look at that chart on gold, you'll see something of the same sort of characteristics. We had a T3 sell signal for Tuesday. That would have been the 26th of November. Now, normally we expect a T3 signal to be elected within 2 days. If we look at the document in the member section, it does say that T3 signals can go as long as 4 days, but from a practical point of view, we like them to be elected in 2 days. But just have a look at what happened here. You had the T3 signal, the sell signal for Tuesday. It was not elected on Tuesday. The next day, the little tiny second inside bar is, of course, Wednesday, was only a half day's trading in equity and bonds, and very, very light volume, nothing happened. Thursday, the market was closed. Friday, you had that T3 signal elected, but we in fact got a very small outside day, and then Monday, whoosh, away she dropped, and it was on its way down towards 735.80, you'll see the first blue line that it's tracking to. So even if you hadn't been cognizant of the T3 signal, if you just look at the whole gold chart as a DC Danielcode setup, exactly the way I describe it to you in the trading manual, you'll see the number we were looking for at that high was 836.70. So on Monday you had the market within 1.5, 2 points of that number. If you cast your eye down the page and you look at the stochastics, there's a slow stochastic and a fast stochastic on top. Both of them were overbought, so we have the complete definition of a Danielcode setup. We have short stochastic overbought, slow stochastic overbought, priced at the Danielcode number, and as well as that we've got a loss of momentum. Now if you just look at the way the close on each of those bars is in relation to the open, you'll see going back to the week before last, huge up day on Thursdays and Friday. Monday, you'll see the market closed about where it opened. That's a loss of momentum. Now there are a number of momentum indicator studies that you should be using to try and identify these things. Having a loss of momentum on top of the other Danielcode setup signals is very, very good. So there was a perfect valid Danielcode sell there. I know time was delayed a bit by the holiday breakup, but you still should have been on the short side and prepared to take that trade on the market. The next chart we're going to look at is the Dow Jones, and we've got a series of charts to look at here. The first one we're looking at is the Dow Jones Index, and these are daily bars, and we'll look for exactly the same sort of thing. You'll see on Friday, week before last, the Dow Jones Index made its high almost exactly at the Danielcode number 88.27, and the fast stochastic was very overbought. Now you'll see that the slow stochastic hadn't quite got to the top. With indices, they move much more quickly than other markets, so you need to use faster techniques on indices. So we can see there that we've got our Danielcode number, we've got our daily bar right where we want it, and we've got the fast stochastic overbought. That should be alerting you for a potential sell. Let's move down a time frame now, and we'll look at the Dow Jones index again. This is the 151 minute chart. Now these markets equity markets vibrate at 148 and 151 minutes. You can use either 148 or 151, either one is valid. It's too complex for me to explain why they switch between one or the other, but just accept that for the moment that those are the next short-term period you should look at. You'll find they're quite revealing. You'll see here the end of the arrow we saw before is actually pointing to the high, which was Friday's high. That's November the 28th, the previous week. And on this 151-minute chart of the index, we can see that the slow stochastic's very overbought, the fast stochastic's very overbought. Where's the target? Where's the market? Exactly right at its Danielcode number, and it hits there twice on 2 consecutive bars. Then you get your turn and away you go, and it dives down. Where does it go to? Well, it goes down to the Danielcode retracement we had on the index, 8139. And it dived down there, and you can see at the time it got down to those lows, and it made 1, 2, 3 bars all together, all testing that Danielcode number. You can see that by then the fast and the slow stochastics had got oversold. That means we have another setup to go the other way to take a buy out of there. We'll move on from there to go to an even shorter time frame, and the next chart we're going to look at is still the Dow Jones, but now we're looking at a 60-minute chart. And you can see there that we've marked the rectangle box for the first position of the stochastic when it was overbought. It went down into a low, it was oversold, and that was the first bar that dived down into the 8139 number. We then got a little rally and a retest of the Danielcode number, the first retest. Notice on that retest that the stochastics have already turned 4 or 5 bars ago. So that's a retest low. It's not going to be a new low. And off the market goes. Where does it go to? Have a look. Its first run up, it goes to the 8549 Danielcode number, and it stops there. Markets do this all the time. They recognize the Danielcode numbers. They will vibrate at these numbers even if they don't turn. So we need to be able to distinguish between a vibration and a turn. In this case, looking at our stochastics, they're nowhere near where we want them. So we endure a pullback, which is fairly scary, but nevertheless on it goes. And it eventually goes and makes its high at 8631. The Danielcode number there that it stopped at is 8651. So it's 20 points away. Now, on an index of 8,000, where we allow a variance of 0.025%, that's well within the variance. It's not just as neat as we'd have liked, but it's well within the variance. And look what's happened to your stochastics. The market finds that number, runs away from it. The stochastics are both highly overbought, and off it goes down again. Where does it go to? Straight back to 8139. So this is now the third test of that Danielcode number, and look where your stochastics are. They're now both very, very oversold, and that's the reason you got the rally. The next chart I want you to look at is the Dow Jones futures contract. It's exactly the same market sequence that we've been looking at, but I want to show you that these markets meet their Danielcode numbers and meet their setup targets on both the cash and the futures. Sometimes it's one or the other, but you need to look at them both. There's no need to flog this one. You can work it out yourself. I've marked the chart there. You can see that Monday's low 8130, Tuesday's low 8145, Friday's low 8125. All of them, in this case the first Monday's low is only 3 points from the Danielcode number. The retest is 12 points, and the final test again on Friday, 8 points away from the Danielcode number. So terrific accuracy. You can see the high 8635. The number we were looking for was 8643. So you need these Danielcode numbers before the rest of this stuff works. When you look at these stochastics setting up so perfectly, the key is to make sure that these markets are at a Danielcode number. You can see all the intermediate turns that did have no effect. That's because they weren't at Danielcode numbers. But when you get the markets hitting their Danielcode numbers, and you get your stochastics jointly in the overbought or oversold position, look out, because you're going to get a reversal. So if you had trouble working out what the market was doing last week, let me tell you, just have a look at the charts here that I've talked to you about tonight, and they will explain everything.